Hello everyone and welcome back to another video. In today's video, I want to go through Nvidia's earnings and then discuss 3 stocks that I am actively buying in the market as the market is selling off. Now before we get into the video, I do want to ask for your feedback on this brand new video setup that I have. I am trying to improve the quality of my videos. And then before we get into it, I also quickly want to let you know that the Black Friday sale on my 30-hour investment course, Mastering Fundamental Analysis, is ending tomorrow by the end of November 21st. So if you have been interested in getting access to my brand new investment course, then do not wait because the sale is ending tomorrow and you can currently save 40% if you go and use the code Black Friday. Now, I also want to let you know that there is a 14-day money-back guarantee. So if you're interested in buying the course, checking it out, but then you realize that it's not for you, then shoot me an email and I will give you a full refund. So there's literally no risk to buying it and checking it out and seeing if it is the right fit for you. But with that being said, let's now hop into the video and get into Nvidia's most recent earnings report. All right, so here we can see that Nvidia is currently down 2% on the day. And after the earnings report yesterday, there was a period where the stock was up roughly 6% in after-hours trading. But as we can see here, it looks like the stock has now given back all of its gains. So as always, I went through the earnings report and I took screenshots of all of the highlights that I think investors need to know. Hello, Sal. So let's hop into my screenshots now. So this first screenshot is a highlight from the earnings report, and it says, Nvidia reported record revenue for the third quarter of $57 billion, up 22% from the previous quarter and up 62% from a year ago. Blackwell sales are off the charts, and cloud GPUs are sold out, said Jensen, the CEO of Nvidia. Compute demand keeps accelerating and compounding across training and inference, each growing exponentially. We've entered the virtuous cycle of AI. The AI ecosystem is scaling fast, and with more new foundational model makers, more AI startups across more industries and in more countries. AI is going everywhere and doing everything all at once. So right away, this earnings report looks like it was fantastic from Nvidia. They're telling us that the quarter-over-quarter revenue growth was 22%. This is a growth rate that most companies don't see on a year-over-year basis. So I think that alone is just wild. But then they're also telling us that revenue continued to grow by over 60% year over year. And this is a company that's doing, over $50 billion in quarterly revenue. So just an insane quarter. Moving on to the next screenshot, which actually came from BD Investing on Twitter. Shout out to BD, great content creator. Here we can see the data center revenue and the year-over-year change to the revenue. And the data center revenue came in at $51.2 billion in the most recent quarter. And we can see that the year-over-year growth rates accelerated to 66%. And just visually, we can clearly see that this was a massive quarter for Nvidia. Data center revenue went from $41 billion last quarter to $51 billion this quarter. This was a massive quarter-over-quarter jump, and it's also the first quarter in Nvidia's history where they grew revenue by over $10 billion in one quarter. So Nvidia is definitely seeing a massive acceleration to their overall revenue. And I think that this is a fantastic thing for the business that's also showing us that demand for Nvidia's GPUs is not slowing down at all. Moving on to the next screenshot, this one shows us some more income statement highlights. We've already discussed revenue, but here we can see that net income increased by 21% quarter over quarter and 65% year over year. Earnings per share also increased by 67% year over year. So not only is the revenue growing by over 60%, but the earnings are as well. And I think that this is great to see. Then Nvidia gave us their outlook, and here they're saying that they expect revenue to be $65 billion plus or minus 2% for the fourth quarter of 2026. Now, I went back to Nvidia's income statement from last year, and if they can hit $65 billion in revenue for the fourth quarter, then that would be 85% year-over-year revenue growth. So on a year-over-year basis, this would mean that Nvidia's revenue is continuing to accelerate. However, on a quarter-over-quarter basis, that would be roughly $8 billion in net revenue growth. And as we just saw in the third quarter, they had over $10 billion of net revenue added. So it's an interesting time because on a year-over-year basis, the numbers will accelerate, but on a quarter-over-quarter basis, this is actually a slight deceleration, which I don't think is bad, by the way. This is still a fantastic outlook, in my opinion. So now let's move on to the earnings call transcript and what really stood out to me. So here Jensen said, "We are still in the early innings of these transitions that will impact our work across every industry. We currently have visibility into $500 billion in Blackwell and Rubin revenue from the start of this year through the end of the calendar year 2026. We believe Nvidia will be the superior choice for the $3 trillion to $4 trillion in annual AI infrastructure build we estimate by the end of the decade. Demand for AI infrastructure continues to exceed our expectations. The clouds are sold out, and our GPU installed base, both new and previous generations, including Blackwell, Hopper, and Ampere, is still fully utilized. At Meta, AI recommendation systems are delivering higher quality and more relevant content, leading to more time spent on apps such as Facebook and Threads. Now, why I wanted to point out this quote specifically is because Jensen is clearly saying that he believes we are still in the early innings of this entire AI revolution. And he also says that Nvidia has $500 billion in revenue visibility in the calendar year of 2026. That is a shocking amount of revenue. So it seems like Jensen does not believe that we are in this AI bubble, and he says that we're actually still in the early stages, as the business is seeing unprecedented demand is exceeding their expectations. And then what he also says here is that the cloud hyperscalers are still sold out of all of their capacity. They cannot build fast enough, and they still need a lot more GPUs to actually execute on all of the demand. Then lastly, he's saying that Meta's AI recommendations are causing more people to spend more time on apps like Facebook and Instagram. So AI is having a real positive impact on Meta's business as well. And I think that Jensen is saying this to try and highlight that AI is having a real positive impact on businesses and some of the largest businesses in the world. Because it seems like right now, there's this huge debate on whether this massive capex that the hyperscalers are doing is actually having a positive ROI, or if it's basically just going to be a massive money waste in the long term. So I think by him saying that, well, these companies are still sold out. Sorry, my cats like to do this. But him saying that, these companies' demand is still sold out, their capacity is sold out, and they're seeing a real positive developments to their business, I think is suggesting that their capex is actually paying off and they're actually seeing positive returns on investments. And maybe this is him trying to put to bed the whole questionability on if the capex is actually worth it or not, because that's a major reason why Meta stock saw such a large drop after their most recent earnings report, which we are going to be getting into later on in the video. So in my opinion, I thought that this was an absolutely fantastic earnings report from Nvidia. I actually am blown away. I can't even believe the numbers that I'm reading. Like, I literally cannot believe that a business doing $57 billion in quarterly revenue is still seeing growth rates above 60%. This is something that I've just simply never seen before. I don't think the market has ever seen anything like this before. And I think that this is truly a once-in-a-lifetime company. I don't think we're going to see a company scale its business so quickly, so rapidly, and grow at such high growth rates from such a large base. It's absolutely mind-blowing. And I'm going to get into the reasons why I don't own Nvidia later on in this video, because that's probably going to be the number one question. Because if this is truly a once-in-a-lifetime company, then why is it not in my portfolio? Which I think is very fair. But before we get into that, I want to show you some of the things that I'm seeing on social media, because it seems like when you have such a dominant, such a high-quality business that is posting these fantastic growth rates, it brings in a lot of haters and it brings in a lot of doubters. So I want to show you some of the viral posts that I'm seeing on X that are bashing Nvidia's most recent quarter, and then explain my thoughts towards these tweets. So the first one right here is from Nobody Special, and he says, Nvidia's accounts receivables grew by $5.58 billion quarter over quarter. Take away growth in accounts receivable, and revenue misses by $3.49 billion. Another manufactured beat. So this person is saying that Nvidia only beat their estimates because their accounts receivables grew by $3.5 billion essentially. And if their accounts receivables did not grow by this much, then Nvidia would have actually missed revenue estimates. So he's saying that this was a manufactured beat and not a real beat. To put this as simply as I possibly can, this is false. How accounts receivables work is it is revenue that is committed to the business, but it has not yet been paid for. So these are commitments that customers have made to Nvidia, but the actual cash has not yet been paid to Nvidia. And since the cash has not been paid, it goes as an accounts receivable on the income statement. This is normal. This is how accounting works. I have many software companies in my own portfolio who report revenue, but the revenue is not actually paid for yet. And then it goes to the accounts receivables number on the balance sheet. And that accounts receivables number is then paid over time and turns into cash flow for the business. That is just how this works. And I think that this person just is simply getting it wrong. And this is quite literally a non factor. NVIDIA is not manufacturing a revenue beat. Then I found another tweet by the Coastal Journal who says, NVIDIA says demand is off the chart, but the cash disagrees. Revenue grew 22% quarter over quarter, but operating cash flow declined by 13% quarter over quarter. If demand were truly insane, then cash flows would be too. Instead, revenue soars while operating cash flow sinks. A classic sign of accounting boosting, the story, not the cash. So I went over to NVIDIA's cash flow statement to take a look at, okay, well, why is the operating cash flow down and what's going on here? So in NVIDIA's cash flow statement for the third quarter, we can see that accounts receivable was that $5.58 billion, and inventories were also $4.8 billion. Whereas we can see that last year, accounts receivables were $3.56 billion, and inventories were only $978 million, basically $1 billion. Then year to date, we can see that accounts receivables has impacted operating cash flows by $10.3 billion, and Nvidia has spent roughly $10 billion on inventories. Now, in my opinion, what this cash flow statement is showing us is actually that Nvidia's demand is increasing. When your accounts receivables is increasing on your cash flow statement, it's a sign that customers are committing more money to your business. Again, this is future cash that has to be paid by customers. So when your accounts receivables again is increasing, it means that your business is expecting to receive more cash from customers in the future. Therefore, demand is increasing. Additionally, when a business is investing more money into their inventories, as you can see here on the cash flow statement, which is clearly impacting operating cash flows, that is a suggestion that Nvidia is having to put more money in the short term into growing its inventory to meet demand. So if a business is literally investing an additional $7.5 billion in growing their inventory on a year-over-year basis, then that suggests that they need a lot more inventory. And therefore, demand for their inventory or for their products is actually very high. So I just wanted to point out a couple of the negative tweets that I've been seeing on X, because again, these tweets are going viral. They have thousands of likes. They have hundreds of retweets. But when you take a look at the data and you understand accounting and have been looking at this stuff for years, what they're arguing is actually the complete opposite. They're arguing that NVIDIA is doing some sort of like accounting magic, or that NVIDIA's true demand for their products is declining because operating cash flows are declining. But when you go and take a look at the cash flow statement, it's the completely opposite story. And again, I wanted to highlight this because I see stuff like this go viral on social media all of the time, and it's just simply false. It is incorrect. So I think that it's important to address these things and give you guys the truth. And this is from someone who doesn't own NVIDIA, by the way. I have no stake in the game, but I just want to point out the BS when I see it and kind of just reduce the fears, I think, because I do think that the goal of these posts is to fearmonger. But now there are two questions left to address in this video. The first one is, why is NVIDIA's stock down after they had such an incredible earnings report? And in my opinion, it's because the business is still trading for 24 times sales and 57.5 times free cash flows. Like, don't get me wrong, NVIDIA's business is incredible. They're growing extremely quickly. But when you trade for such high multiples, you have a lot of expectations and future growth already priced into your stock. Which brings me nicely to the second question, which is why I do not own NVIDIA's stock. Well, it really comes down to the price. Pretty much almost everything when I see a high quality business and why I don't own it, it comes down to price. I think that NVIDIA's stock price today is still factoring in a lot of future growth. And one of the main risks with NVIDIA's business is that over 60% of the company's revenue comes from 4 customers, which I imagine are Microsoft, Google, Meta, and Amazon. Those 4 customers, the hyperscalers who are clearly plowing more money into CapEx, make up over half of NVIDIA's revenue. Now, the thing about 2 of these businesses, Amazon and Google, is that they're actively trying to rely less and less on NVIDIA over time. In fact, Gemini 3.0, which was just released, was entirely trained on Google's own TPUs. And if you're a hyperscaler and you're spending literally hundreds of billions of dollars on CapEx, then you're going to want to try and find a place where you can shave off even 10% of your spend. Because if you can trim 10%, you save $10 billion or more. And so I think that These companies are actively trying to rely less and less on Nvidia over time. Right now, they clearly still rely on Nvidia a lot, but over time, I expect them to develop their own products, build their own chips, and rely on Nvidia less and less. And I don't know what that looks like for Nvidia's business over the long term. Again, right now, they're clearly relying on Nvidia to execute on all of the demand they're seeing. But in 5 years, how does that look? Does that kind of level off with the demand? Does demand slow down in 5 years? I don't know. And then the other risk is simply what if in 3 years, Amazon is building out all of this capacity, but then at the end of the 3 years, they're like, hey, you know what? We're going to tone down our capacity building, our data center building, and we're going to tone down our NVIDIA purchasing by 50%. That alone, if Amazon did that, could impact NVIDIA's revenue by a negative 10% growth rate. So I think that there's an extreme customer concentration risk. And these customers are actively trying to move away from NVIDIA. And over the long term, I don't know what that looks like. That, coupled with the fact that NVIDIA's price is trading for such high multiples and pricing in so much future growth, when I just don't know what that future growth looks like over the long term, it causes me to not want to invest in the stock. And I am the first to admit it. I have completely missed NVIDIA's entire run. I have also missed Palantir's entire run. But these businesses are not within my circle of competence and they don't make me feel truly comfortable. And I think that it's important to recognize that you don't need to own the sexiest, most flashiest businesses in the market to perform well as an investor. You just have to stay within your circle of competence and buy things that you truly understand because there's high quality businesses pretty much everywhere. There's high quality businesses in the lending space, in the real estate space, in the infrastructure space. So there's high quality businesses that can outperform the S&P 500, which means that for me, I just want to stay in things that I understand very well, things that I feel absolutely sure about, and stay within my circle of competence. And I will not increase my risk by stepping outside of my circle of competence just to try and boost my returns or get out a few extra percentage points over the S&P 500. It's maybe not for everyone, but that's how I invest. And that's why I'm not in Nvidia and a lot of the large tech companies. That's my investment style. That's what I cover on my channel. And I hope that, everyone can understand that and realize that as well. But those are my thoughts on Nvidia. It was a fantastic quarter. I do think the stock is still looking kind of expensive, and I don't necessarily know what the business looks like over the next 5 years. All right, let's now move on to the 3 stocks that I am actively buying in the market right now. I'm actually buying much more than 3 stocks, but I will be covering all of those in future videos. And one of the stocks that I had been adding is a brand new add to my portfolio. But first, let's start off by discussing Mercado Libre. Now, Mercado Libre is a stock that I have covered for quite some time on my channel, and I have been invested in this business for well over a year now. However, if we take a look here, we can see that the stock was down another 8.5% today. It officially broke below $2,000 per share, and it's selling for $8,999 per share at the time of recording this video. If we take a look, the stock is also now in almost a 30% correction with a market cap of $97 billion now. To put it simply, I do not know why Mercado Libre stock continues to sell off so much, because the last quarter, in my opinion, was extremely good. The business is continuing to see the growth rates to its fundamentals accelerate. It just had a quarter where it posted 39% year-over-year revenue growth, and this is on a revenue base of over $20 billion a year now. This is a fantastic company. I think that it is extremely high quality, and I think that it has a runway that is going to last decades. And I think the price today is just not reflecting the underlying fundamentals and the growth of this business at all. So as Mercado Libre stock has continued to fall, I have continued to consistently buy shares on the way down. I am also not someone who tries to time the bottom or use technical analysis to try and figure out where the bottom is. I simply look at the value of the business and ask if I think the valuation is attractive. And if it is, then I will continue to buy. So again, as Mercado Libre stock continues to fall, expect me to continue buying more and more shares as consistently as I possibly can. But now let's head into some screenshots that I have from some recent news with Mercado Libre's business, and I'll update you all with some of the business news. Just a couple of days ago on LinkedIn, the manager of Mercado Libre Mexico put out this post where he said, "We broke our records again. Once again, we demonstrate that we are the marketplace with the best value proposition for our users, and that on a date as relevant as this, our ecosystem is the best ally to empower businesses. Millions of people chose and trusted Mercado Libre to take advantage of unmissable discounts and receive their purchases with the fastest shipping in the country. Here's some interesting facts. Monday was the best sales day in the history of Mercado Libre Mexico, with more than 3,000 purchases per minute. More than 40 million offers were on the platform as well. And then skipping down to the very end, he says, "We continue working to close 2025, showing everything we are capable of achieving." So the manager of Mercado Libre Mexico is telling us that they just had their best sales day in the company's entire history, where they sold 3,000 items per minute. And it seems like Mercado Libre is continuing to take market share in the e-commerce space within Mexico. And I have some people in my Patreon who are from Mexico and actually use Mercado Libre, and they have made it clear that Mercado Libre vans are all over the place. And the company is clearly outperforming Amazon in the country. And I know that there has been an increased worry about the increasing competition in Latin America with Shopee entering the market and investing more down there, and with Amazon also trying to invest more in Latin America, especially in Brazil. But every single year, Mercado Libre is continuing to take more and more market share. So it seems like companies are not able to effectively compete against Mercado Libre, and they are still maintaining and growing their leadership position in the region. And I think that digital banking and retail is only going to continue growing in Latin America for literally decades to come. This is an area of the world that is heavily underserved with digital banking, and Mercado Libre is the number one down there. They're not number one in Brazil, but across Latin America, they are number one. And across Latin America, they're also the number one e-commerce platform. So this is a business that I think has massive and long tailwinds behind it. It is continuing to grow 39% year over year, take market share, and I think that the business's valuation today is not reflecting its underlying fundamental growth. So let's head over back to Stock Unlock, and I just want to show you some metrics of Mercado Libre. So let's head back over to Stock Unlock, and I just want to show you some quick metrics for Mercado Libre. Let's take a look at their revenue since they IPO'd all the way back in 2006. And over the past 15 years, Mercado Libre has maintained a compounded annual growth rate of 39% to its revenue, and it is still, to this day, maintaining that 39% compounded annual growth rate. In the trailing 12 months, the company has now done $26.2 billion in total revenue. If we head over to their KPIs, we can see that their gross merchandise volume hit $60 billion in the trailing 12 months, and the gross merchandise volume is re-accelerating in the past couple of quarters. Now, the reason the GMV is accelerating is partly because Mercado Libre lowered its free shipping hurdles on items in Brazil. They do this routinely. This is actually the third time that they have done this, but every time they lower their free shipping hurdles, analysts freak out and they sell off the stock because it is a short-term impact to the company's operating margin. But the reason Mercado Libre does this is to increase their competitive advantage in the region. And for a competitor like Amazon, who doesn't have as robust of an e-commerce distribution platform, for them to try and offer the same items for free, to ship these items for free, they would be losing a significant amount of money because they do not have those economies of scale to actually pass on those savings to customers. Mercado Libre is quite literally taking the Costco playbook here. As they scale up the business and they get those economies of scale, they share those with their customers and remove the hurdles for free shipping so that it makes their platform and their ecosystem even more attractive for a consumer. And as more consumers join Mercado Libre, sign up to the platform, and become buyers on the platform, it also attracts more businesses to the platform as well. Because if you're a business and you want to sell your products online, where are you going to sell them? You're going to sell them with a place that has the most buyers. So as more buyers are attracted, more businesses are also attracted, and that is how one of the flywheels turns. Then you also have the fintech business, and let's take a look at how the fintech business is doing. And here we can see that Mercado Libre's fintech business has now done $11.3 billion in trailing 12 months revenue, and the fintech revenue has been accelerating over the past few quarters. Now, Mercado Libre's fintech business gets compared a lot to Nubank. So let's go and take a look at Nubank, which is purely a fintech company. It's a digital bank in Latin America. And here we can see that Nubank has now done about $14 billion in trailing 12 months revenue. Now, what this means is that Mercado Libre's fintech segment of their business is only roughly 27% smaller than Nubank's entire business. And Nubank is a $76 billion company on the stock market today. Again, Mercado Libre is a $96 billion business, and they also have a massive e-commerce business. They have an advertising business, they have a credit card business, and a robust fintech business as well. So even if you just compare Mercado Libre to Nubank, I think Mercado Libre is much more diversified. Their fintech business is almost as big as Nubank, and it's actually catching up to Nubank as well. And Mercado Libre is only worth roughly $20 billion more on the market. And when I take a look at every fundamental metric on Mercado Libre, I see it continuing to grow and scale extremely quickly. So the stock seems to be heading in the opposite direction of the business's underlying fundamentals, when I believe that the fundamentals are only continuing to grow and the competitive advantages of the business are only strengthening as well. In my opinion, we're currently in this market where a lot of high quality businesses are now seeing their share prices come down in a pretty meaningful way. It seems to be almost indiscriminate selling at this point, and I think that when this is starting to happen, if you can identify the fundamentally sound businesses that are truly, truly high quality and world class businesses, then this is the type of market where it's a great time to be a buyer. So I am trying my best to remain focused on the fundamentals of Mercado Libre and the other businesses that I'm going to show you, and just continue to buy while the share price is going down. You have got to get in the mindset of seeing falling share prices as a good thing for your long-term investing, because it's in your best interest to buy shares of these businesses for as cheap as you possibly can. Now, moving on to the next stock, this is going to shock absolutely no one. I already know it, but I am continuing to buy more Brookfield Corporation. I try to keep this position around 25% of my entire portfolio. So as I continue to get more cash within my portfolio, or Brookfield Corporation drops relative to my portfolio, I try to top it up and keep it around that 25% level. So this is a stock that I am pretty much always buying, one, because I want to keep it at that 25% level, and two, because I do believe that the stock is truly still offering value in the market today relative to what I think the business will produce in terms of cash flow in the future. So I do have a couple of screenshots here that I want to show you, because there has been some recent news with this business. So here's the first screenshot from an article that says, the build out of foundational infrastructure necessary to support artificial intelligence and digitalization is projected to require approximately $7 trillion in capital over the next decade. Brookfield is aggressively positioning itself to capture this market, leveraging its existing $100 billion investment base in digital infrastructure and clean power. A transformative initiative is the launch of a $100 billion global AI infrastructure platform, anchored by the Brookfield Artificial Intelligence Infrastructure Fund. This platform involves strategic partnerships with technology leaders like Nvidia and institutional investors such as the Kuwait Investment Authority. Brookfield's deployment strategy focuses specifically on the physical, foundational backbone of AI: energy, land, data centers, and compute capacity. This approach effectively positions BN as a critical utility provider to the burgeoning AI industry. Instead of focusing on volatile software or hardware, BN owns and operates the essential, mission-critical assets that guarantee long-term, contracted, and inflation-protected revenue streams. Then from Brookfield's own press release on this partnership, here they say, "We are thrilled to formally launch our dedicated AI program in partnership with Nvidia and others to deliver this infrastructure at speed, at scale, and to the highest standard for enterprises, technology firms, and sovereign governments. AI is transforming every industry, and like electricity, it will require every nation to build the infrastructure to power it. AI infrastructure demands land, power, and purpose-built supercomputers, and our partnership with Brookfield brings all of these elements together and are ready to deploy AI cloud," said Jensen, the founder and CEO of Nvidia. So Brookfield has officially launched their AI infrastructure fund, and they launched it in partnership with Nvidia. And the CEO of Nvidia himself, Jensen, said that he is excited to be working with Brookfield and that this is a world-class company that is going to build out the infrastructure for AI going forward. Now, what's also interesting is Bruce Flatt, who is the CEO of Brookfield Corporation, said that he thinks this AI segment of Brookfield that they're currently starting out and getting started could become the largest profit generator for the business over the long term. But it is great to see that Brookfield is getting this fund launched and they have world-class partners from day one. So we're going to have to see how this one plays out, but the underlying fundamentals of Brookfield, in my opinion, are only continue to strengthen as well. Additionally, this next screenshot comes from Brookfield's Investor Day presentation that they had in September of this year. And here they say that looking forward, they expect to generate $53 billion of free cash flow over the next 5 years. That is $53 billion of cold, hard cash that they are going to have the optionality to deploy however they see fit. It could be paying more dividends, it could be buying back shares, acquiring new businesses, but this is a significant amount of capital that the business is projecting to produce just over the next 5 years. Now, this next screenshot also shows us that the operational earnings of the business are projected to compound by 17% annually out to 2030. And when you factor in capital allocation and realized carried interest, they are expecting their distributable earnings per share to compound by 25% annually over the next 5 years. So let's head over to Stock Unlock's discounted cash flow calculator now, and I want to show you why I think that Brookfield is still looking cheap in the market today. So here I am projecting out their distributable earnings over the next 5 years, and I'm saying that distributable earnings will continue to grow by 22% annually, the company will continue to buy back 1% of its shares annually, and Brookfield will trade for roughly 17 times distributable earnings at the end of the period. So in this DCF, I am factoring in some slight multiple compression to BN's share price, and a slight miss to their 5-year projection of 25% annual growth. But even with this slight pessimism factored in, we still get a 20% compounded annual growth rate to Brookfield's share price and a fair value of roughly $68 per share US, which is 56% above where the stock is currently trading. So basically, if Brookfield Corporation can meet their 5-year projections and maintain a price to distributable earnings of at least 17, which is below where the company is currently trading, then the stock could still offer some pretty stellar returns going forward. This is a world-class company with world-class management and a very strong reputation that is continuing to grow extremely well, and they're actually projecting acceleration to their growth over the next 5 years. I simply think that this company has exposure to so many global tailwinds, and it is almost sure to continue growing over the long term. And due to me having such strong conviction that this business will continue to grow, and also believing that it is so high quality with such great management, that is why it is the largest position in my portfolio and why I continue to buy it despite it selling right near all-time highs. To put it simply, if Brookfield Corporation can actually meet their 5-year targets, then I think the business is going to be worth a lot more in the next 5 years. And again, the share price will continue to perform very, very well. And that's why I continue to buy Brookfield. All right, let's now move on to the third stock that I am actively buying. And this one is a brand new stock that I have added to my portfolio. So drum roll, please. It is Meta. Meta is a stock that I owned in my portfolio a while ago. I was buying it on the way down in, I think it was 2022, 2023. When the stock dropped from like 300 down to 90, I was buying it on the way down. I think my lowest buy was $90 per share. But then on the way back up, I exited my position around $250 for an over 100% gain on the total position. But in hindsight, as I have told my YouTube channel before, I do think that selling Meta was a mistake. And since then, I have been continuing to follow the business and be extremely impressed with its underlying fundamental growth. So let's take a quick look at some of Meta's fundamentals here and why I am buying this stock today. Let's start off by taking a look at Meta's revenue. And here we can see that in the trailing 12 months, they have now produced roughly $190 billion in revenue. And if we take a look at a quarterly basis, the most recent quarter was incredibly strong at $51.24 billion in revenue. And what's interesting is Meta grew its revenue by 26% in the third quarter, which was the fastest growth rate that all of the hyperscalers have seen. But this is the one company that saw its share price drop quite a bit after the most recent earnings, when in my opinion, they actually had the most impressive report. So seeing Meta sell off after what I thought was the best report immediately got my attention. But after seeing it continue to fall below $600 per share, it's at the point now where I'm like, all right, I think the risk reward here on Meta is pretty impressive when they're seeing accelerated revenue growth. And I also believe that all of the investments they're doing in capital expenditures and into AI is clearly paying off because the business's revenue, once again, is re-accelerating. They have the best revenue growth out of the hyperscalers. And if we also take a look at their operating cash flows, they are continuing to grow incredibly well and have hit roughly $108 billion in the trailing 12 months now. Now, I also went through the transcript from the third quarter results, and I found some highlights that I want to share with you that help explain why Meta is spending so much on capital expenditures and why they believe that this CapEx will produce a high return on investment for the company. So here Mark Zuckerberg said, "We keep on seeing this pattern where we build some amount of infrastructure to what we think is an aggressive assumption, and then we keep on having more demand to be able to use more compute, especially in the core business in ways that we think would be quite profitable than we end up having compute for. So I think that suggests that being able to make a significantly larger investment here is very likely to be a profitable thing over some period. Because if the primary use of it is going to be to accelerate the AI research and the new AI work that we're doing, and how that relates to both the core business and new products, but any compute that we don't need for that, we feel pretty good that we're going to be able to absorb a very large amount of that to just convert it into more intelligence and better recommendations in our family of apps and ads in a profitable way. Now, I mean, it's of course possible to overshoot that, right? If we do, I mean, this is what I mentioned in my comments, then we see that there's just a lot of demand for other new things that we build internally and externally. Like almost every week, people come to us from outside the company asking us to stand up an API service or asking if we have different compute that they could get from us. And we haven't done that yet. But obviously, if you got to a point where you overbuilt, you could have that option. And then the kind of very worst case would be that we effectively have just pre-built for a couple of years, in which case, of course, there would be some loss and depreciation, but we'd grow into that use over time. The right thing to do is to try and accelerate this to make sure that we have the compute that we need, both for AI research and the new things that we're doing. So my view on this is that rather than continuing to be constrained on CapEx and feeling in the core business, like we have significant investments that we could make that we're not able to make that would be profitable, that the right thing to do is just to try and accelerate this to make sure that we have the compute that we need, both for AI research and new things that we're doing. I think that there's just a huge, huge amount of opportunities ahead here. So what I am gathering from what Mark Zuckerberg said in the Q3 conference call is that Meta is constantly capacity constrained. They cannot invest enough money into building out their capacity to support the growth of their core business and the new products that they're launching and offering. So he's saying that rather than continue to be capacity constrained, they're just going to plow as much money as they possibly can to capture all of the opportunity because he believes that there is a massive opportunity ahead for the company. And if we go back to what Jensen said in the most recent earnings call for Nvidia, he is clearly pointing out that AI is materially benefiting Meta's business. People are spending more time watching Reels, they're spending more time watching videos on Facebook, the ad conversion rates are going up, and due to the conversion rates of their ads going up and people spending more time on the family of apps, it is causing advertisers to be more attracted to Meta's platform. I shared a chart in one of my recent videos that showed that Meta is taking market share in the United States digital advertising market. Google is clearly still number one, and they have the most total amount of advertising dollars spent on their platform, but Meta is catching up and they are taking market share. And in the most recent quarter especially, Meta saw the highest amount of acceleration to their advertising revenue. This is a clear indicator, at least in my own opinion, that they are attracting more advertising dollars relative to even the other hyperscalers like Amazon and Google, which also suggests to me that advertisers are getting the highest return on their advertising spend by going over to Meta. So therefore, Meta is clearly doing something right because they are attracting so much more advertising dollars. And again, I think that this is a pretty clear indicator that the capex that Meta is making within their own business is having a material positive impact on the profitability of their company, the growth of their company, and the return on advertising spend that their customers are getting on their platform. So all of this is kind of, to me at least, showing that Mark Zuckerberg isn't just blowing smoke up everyone's behind here. I think that their capex is actually paying off, and the fact that they want to continue accelerating this capex, it's kind of at the point where I'm just like, I see it, I see the growth, I see the growth of the profitability, the operating cash flows are growing, and I trust the Zuck, as they want to say. Now, if you have also been watching my channel for some time, then you know that I am also someone who likes to focus on making sure that I get a good going-in valuation to an investment. So let's head back over to Stock Unlock here really quickly, and I want to show you how I am thinking about Meta's valuation today. So let's head over and take a look at its price to operating cash flow, which I do think is the best metric to use on all of the hyperscalers right now. So if we zoom in here, we can see that Meta is now trading for a price to operating cash flow of roughly 13.8. And if we zoom into roughly the past decade here, we can see that its average has been roughly 18 and the median has been roughly 17.5. So Meta is trading well below its historical average price to operating cash flow multiple. And even just on its own basis, a 13.8 price to operating cash flow for one of the highest quality businesses in the world, in my opinion, is a pretty compelling going in price. So let's head over to Stock Unlock's discounted cash flow calculator now, and I want to play around and show you how I'm thinking about the valuation and future return potential today. So here I am projecting out the operating cash flow over the next 5 years, and I'm saying that Meta could grow its operating cash flows by 15% annually, buy back 2% of its shares, and trade for 15 times operating cash flows, which is still well below the company's long-term average of roughly 18. And in this scenario, Meta's share price could produce a compounded annual growth rate of 19% per year, and its fair value would be $887, which is roughly 50% above where the stock is currently trading. Now, in my opinion, this would be a slightly more optimistic DCF with this growth rate of 15% per year. So let's knock this growth rate down to 12%. And even in this scenario, the share price could still compound by roughly 16% per year, and the fair value would be $778 per share. So in my opinion, even on some pretty pessimistic growth rates of 12% annually to Meta's operating cash flows from here, and a very fair multiple of 15 times operating cash flows, then the share price could produce a market-beating return. So I think the market has kind of thrown out Meta stock right now, and if I had to guess, it's because people are worried about the massive capex that they're projecting to do over the next couple of years. But for myself, being a long-term investor who believes that these capital expenditures are actually going to result in material business growth and profitability growth over the long term, I think that this is a good entry price. And that is why I have started to buy Meta stock. I have taken on a small initial position. I have not like loaded in because I'm buying all over the place with the market selling off. But this is a new stock that I have added to my portfolio. It's still a very small position for me. But if the share price does remain down, or if it continues to fall, then I will continue to nibble on it and make it a larger and larger position over time. But when you have stocks like Mercado Libre selling off and Constellation Software also selling, it's very hard because everything looks attractive right now, at least in my own opinion, with the stocks in my portfolio. But Meta is a new stock that I have added. And again, I could see myself adding more. So those are the three stocks that I am actively buying. There's more that I will be discussing in future videos. And also those are my opinions on Nvidia. Now, before I wrap up the video, I do just want to remind you once again that the Black Friday sale on my course is ending tomorrow. So once again, if you are interested in getting access to my 30-hour investment course that is packed with knowledge, packed with everything I know about investing, then do not wait because the sale will be ending soon. I also put a link at the top of the description that you can click on that automatically applies the coupon code to save 40%. So if you're interested, make sure to click that link and do not wait. But with all that being said, thank you all so much for tuning into the video today. As always, I truly do appreciate it, and I really hope to see you again in my next video.